Hello and welcome everyone to another market commentary from StashAway. I'm very happy to be back after I've missed the last session with my co-hosts, Freddy, our Chief Investment Officer, and our Deputy Chief Investment Officer. Stephanie, how are you two?
Well, good to have you back, Philip.
Yeah, exactly. I think our audience miss you.
Oh, good. No, I'm excited to be back, and obviously, it's been over the last 2 weeks since the last call. Obviously, there's a few things that are hitting our screens and news cycles that we want to get into today. So we got a ton of questions. They're also around one topic, which is called Evergrande. We're going to get there in a little bit. But that's not the whole story, right, Freddy? How about you give us a little bit of an update on the markets in general, because we're seeing some softening in those over the last 2 weeks, right?
Yeah, it's actually Evergrande's impact on market is still quite limited at the moment, but we've seen a combination of many other events going on. And one of the other events going on is, two Fed governors were they are stepping down because of trading scandals. So, while policy making, you are trading in your personal accounts.
It's quite interesting that that's still happening these days, right? With, everyone knows, everyone is visible, right?
Yeah, exactly. So that amazing that this kind of governance issues at a government level is actually more prevalent than in securities firm, right? So that's a big news. But also you got a lot of stuff like there's a lot of China energy outage, and which is related to China's commitment to carbon emissions, and states are getting quotas to try to get there. And yet they were overwhelmed with a lot of demands for what they produced. So there's this little supply chain problem that's compounding a little more. So supply chain threat, the latest one is China energy. And you have people worrying about inflation still, which is the reason why StashAway reoptimized portfolio in July, which is primarily centered around this inflationary pressure from supply chain threats. So those things are coming in play. And in terms of the latest, you also have news that you got institutional demand for Evergrande's bonds, and you have state media saying national players may start looking at the assets Evergrande has and want to take them off. So that's actually also silver lining among all these noises. There's just so much going on. So I would say generally things are slowing in because of a combination of many things, not exactly particularly to any one event at the moment.
Yeah. You can't pinpoint it to just one. If I do go back to just on the inflation piece, because you said obviously we already optimized a while ago for this kind of scenario, and now that it's we've done that for a while now, and you kind of play it out over the summer, right? It seems to be getting worse. But even I think the Federal Reserve came out a few weeks ago where they said, hey, they are thinking it's going to be a temporary thing until the supply chain issues are sorted, which will still take a while, right? Do you think it's a temporary thing, or is it also driven by easy monetary policy? Any other insights that you might have, Freddy?
Well, I wouldn't blame the central banks for rescuing the markets, but I would say that it's a function of COVID-19, the pandemic. The widespread impact on supply chain is a very real thing. You have shoe making makers having issues in somewhere in Vietnam, or you basically have issues widespread where some countries are on lockdown still. They are not they're not advanced in the vaccination cycle, and they have this frequent outages themselves. And even China at a port level, sometimes for one cases on a ship, they could close down the whole port. So you will have all these disruptions happening quite frequently in the eye of this pandemic that can only be resolved when industry adjusts to it, which takes a few years, or when we manage to reopen because of the vaccination drive or herd immunity, either one of them, right? So there's a natural cycle order of things to happen, and we felt that as a firm, it will linger for a few years, between 1 to 3 years. So we felt that's sort of enough for us to react to it. Generally, our time frame can be even longer, 3 years or more. But in this case, it's with a 1 to 3 year time frame. we felt that needs to be addressed right now, and we did it in July.
No, absolutely. No, I think thank you for explaining that again, Freddie, why we've done this. And I think, like you said, hopefully the Western countries are starting to help on that vaccination drive and start shipping vaccinations that are not being used in the Western world over to the places where they actually need it. With that being said, let's go into the Evergrande fiasco or saga that we've been covering. Stephanie, any thoughts on Evergrande and broader market implications? We get obviously a lot of questions around that. You want to give us a little bit of an update from your point of view there?
Yeah, sure. I mean, the whole Evergrande saga, I think it really accelerated in the past few weeks. But in fact, it's been brewing for quite some time already. If you look at some of the Evergrande credit, look at the bonds, they've actually been like going down from 80 cents to the dollar to trading at 30 cents to the dollar recently. So, I mean, this is due to a few things that are happening in China. Number one, there's been a tightening of monetary policy since the beginning of the year. And then secondly, China is taking a few steps to really curb down on the property sector. Namely like limiting lending for property developers, or even just trying to cap like the home prices. So it's very fundamental. I mean, in China, the property sector is actually very, very big. It takes up 30% of GDP according to some estimates. And this is way, way higher than, for example, in the US or other countries. And given China's concern on credit just accelerating, property, of course, takes up quite a bit of that. And so, I mean, it is like sort of China's deleveraging effort. And Evergrande has a huge amount of debt, as we all come to understand now. But I would say a few things about this. Number one is that the incident seems to be quite isolated. Now, of course, S&P also, for example, downgraded a few other property developers who are also in similar situations as Evergrande, but they are like generally quite small. So names like Fantasia, they're a lot smaller. And if we look at the top 10 developers in China, so Evergrande by sales, Evergrande was the biggest one. But for the 9 other biggest developers, I mean, their bonds are still trading at around 90 to 100. So it's not a systemic risk from that point of view. I mean, from a Evergrande kind of standalone basis, there are a few risks that China has to manage. Number one is, of course, the unfinished flats that they need to deliver to buyers of Evergrande
because that's
apartments.
Actually the retail side that is in distress.
Exactly, right?
The actual retail buyers, right?
Yeah, and so I mean, you're seeing headlines saying, I mean, China is instructing the banks to make sure, I mean, these like flats are delivered, because ultimately, if these flats aren't delivered, there's going to be a lot of disgruntled buyers. And then secondly, for the onshore bonds, I mean, we've seen some development last week. Basically, they are resolving the coupon payments. There's very little details disclosed, but I mean, those debts are being worked out, restructured, namely, right? If you look at Evergrande offshore bonds, that may be a different story. These bonds are now trading at 25 to 30 cents on the dollar, which from a Western kind of traditional bond investor point of view, these are called distressed debts. So i.e. the bond market is already expecting them to default. And indeed, there's just one headline this morning that came out that says one of the distressed asset managers in the US have started buying up these offshore bonds. So, I mean, things are moving. And I think the key thing to keep in mind is that Evergrande is a big developer. However, it won't cause systemic risk in China.
Because they have real assets for even state companies to sort of acquire on the cheap. So like Stephanie mentioned, the recovery, if you assume recovery value is around 25% to 30% of market cap, and your bonds trading at 25 to 30 cents on the dollar, that means the market already well embraced and well prepared for 100% chance of a default. But the recovery value is basically what's left over that can be sold and scrapped. And that's why people buy the distressed bonds, right? So there are professionals in the industry that focus on that, and they are coming in. So I think that's clarify if I'm wrong. I think that's what Stephanie is saying.
Yeah, and I think it's also, people have been also drawing parallels to 08, 09 and Lehman Brothers, which is completely a different story, right? They were so entangled in the US economy, right? And also every investment bank had their fingers in the game, and they were all having.
Yeah, you're actually right. Even though Evergrande's value was around $300 billion in liabilities and Lehman was 600, but 2008 wasn't caused by Lehman alone. The whole subprime market plus leverage plus the entire banking system, we're talking about a couple of trillions of dollars, right? So I think that's not a fair comparison. But I think the main thing is that we've seen a lot of questions about how much Evergrande Holdings Asia High Yield Corporate Bond ETF has, and whether they affect KWEB. And I would like to address them here. KWEB is China Tech. It has no exposure explicitly to Evergrande. If there's any sort of correlated risk, it will be the same as with any other person, S&P 500 or anyone. That sentiment, yes, sure, there's always that correlation risk. But in terms of holdings, none. In terms of our Asian high yield corporate bond, which is a smaller portion of our income portfolio, that particular ETF has only a total of 1.14% of market value in Evergrande bonds on the cheap. So out the other 98.86% of holdings were not related. So it seems like so far, all our systemic risk indicators didn't flare up. Stephanie's mentioned about isolated risks and looking at how other developers within China's trading, it looks very isolated. National players are scooping up assets at recovery value. Foreign investors, distressed investors are interested. So to me, all those points comes together to say that it looks like the 1.14 percentage point of exposure in just one ETF out of the many in the portfolio, it seems very, very much like a non-event for StashAway.
Yeah, absolutely non-event. And I think this is where you get rewarded for staying invested. I think those are always the times where you can, if you listen to us over the last 2-3 years now, as long as Freddy and I have done it, we always have these geopolitically isolated things happening, right? And they always move on. And in the end, if we would have just stayed put, the markets do move up over time, right? So. Thanks you both for your input on all of those. A lot of questions on that. I do want to remind our listeners there's some very, very interesting webinars coming up in all of our different regions. So first up is actually in Singapore on Tuesday, the 5th of October at 7 p.m. We have an Ask Me Anything. It's called Introducing Thematic Portfolios. As you might have noticed in your StashAway app or on our website, we launched what's called Thematic Portfolios, and we will have an Ask Me Anything about it. So join us Tuesday, the 5th of October, 7 p.m. Singapore time, and ask us as many questions as you want. We'll give an overview of what they are, how they might fit into your portfolio as well. That's on the 5th in Singapore. On the 12th of October, also in Singapore, we have what's called an International Diversification FX Hedging webinar. So join us for that. Again, 7 p.m., 12th of October. For Malaysia, we have an Ask Me Anything, also introducing our thematic portfolios. That's on the 6th of October at 6 p.m. local time. So join us for that. Also in Malaysia, upcoming the week after, on the 13th of October, we have what's called How to Plan for Your Retirement. So if you want to learn more about retirement planning, what you can do now in order to maybe retire early, join us for that. And last but not least, for our MENA region, we also have our Introduction to Thematic Portfolios Ask Me Anything. It's actually on Monday, the 4th of October at 6 p.m. local time. So please feel free to join those talks. We would like to see as many of you as possible, as always. We have the sign-up links in the show notes below. You can also find them on our website, on our Eventbrite page, social media accounts, wherever else you interact with us. We're looking very much forward to seeing you at those. And just a little sneak peek as well. Freddy, myself, and Stephanie will also be recording a podcast in the coming week about thematic portfolios. We'll really go in depth on that as well. So if you want to take a look out for that. It should come out in a few weeks' time on our podcast called In Your Best Interest. With that being said, again, Freddy, Stephanie, thank you so much for joining me today. Thank you all for listening, and we'll be with you again shortly. Until then, have a wonderful rest of your week. Bye-bye. Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.